The stock market of the future belongs to technology, to artificial intelligence, to the same 7 giant companies that have dominated every headline for the last 3 years. But what if I told you that, quietly, behind the scenes, the big money on Wall Street is starting to move in a very different direction? Right now, while most retail investors are still obsessed with Nvidia, Amazon, Tesla, and the rest of the Magnificent Seven, the largest banks and institutions are preparing for 2026 with a completely different playbook. They're rotating out of big tech and into what many people call old-school stocks. And if you keep thinking the future is only about technology, you might miss one of the most important market shifts of this decade. In this video, I'm going to explain, in simple words and step by step, why Wall Street is quietly betting on boring sectors like healthcare, industrials, energy, and small caps, why they believe these sectors could outperform big tech in 2026, and what this means for you if you're trying to protect your money and grow your wealth in the next few years. So stay until the end, because this isn't just another news summary. This is the kind of information that can change how you invest, how you think about risk, and how you prepare for the next big rotation in the market. Let's start with the big picture. For the last 3 years, the U.S. stock market has been dominated by a very small group of companies, the so-called Magnificent Seven. We're talking about giants like Nvidia, Amazon, Microsoft, Apple, Tesla, Alphabet, and Meta. These companies became almost a shortcut to making money. You didn't need deep analysis, you didn't need a complex strategy. You just needed to buy the same tech names everyone else was buying, and the market did the rest for you. Their share prices exploded. Together, they pulled the entire S&P 500 higher. In fact, the tech sector has climbed around 300% since this bull market began, which is an insane performance for such a short period. But here's the problem. When one group of stocks rises that fast, for that long, valuations eventually become unrealistic. Prices start to reflect not just strong profits today, but profits that might only arrive years in the future. And if those expectations are not met, even slightly, Wall Street reacts fast. That's exactly what we've just seen with some big AI names. Companies like Oracle and Broadcom recently disappointed the market with results that didn't fully match the hype around artificial intelligence. They didn't post terrible numbers, they just didn't deliver perfection. And when a stock is priced for perfection, anything less becomes a problem. So now, a question is spreading across trading desks in New York. How much more upside is really left in these giants compared to the rest of the market? This is where the rotation story begins. Several major institutions are now publicly telling their clients, don't put all your money in big tech. Look at the rest of the market. Bank of America, Morgan Stanley, Strategas, HSBC, Yardeni Research. They're all sending the same message. It's time to look beyond the Magnificent Seven and pay attention to sectors that have been ignored for years. What sectors are we talking about? Healthcare, industrials, energy, financials, consumer discretionary, and especially small and mid-cap stocks. These are companies that don't always appear on the front page, but that can grow faster when the economic cycle turns in their favor. And according to these strategists, that new cycle is starting now. They describe today's environment as an early cycle context. In simple terms, that means the economy recently hit a soft bottom and is now starting to recover. Inflation is more under control, growth expectations are stabilizing, and the Federal Reserve is no longer raising interest rates. In fact, the Fed has already cut rates 3 meetings in a row and expects to cut again next year. Lower interest rates are gasoline for certain types of stocks. They help banks, they support small businesses, they reduce borrowing costs for companies that need capital to grow. They encourage investors to move away from ultra-safe assets and back into risk. And that's exactly what we're seeing in the numbers. Since late November, the Russell 2000, an index of small-cap U.S. companies, has gained around 11%, while an index tracking the Magnificent Seven has gained only about half of that. At the same time, the S&P 500 Equal Weight Index, which gives the same importance to every company, has started to outperform the traditional S&P 500, where big tech usually has all the power. What does that tell us? That the rally is no longer just about the giants. The strength is spreading. The market is finally broadening out. For years, people complained that only 7 stocks are pushing the market higher. Well, now that might be changing.